ladies and gentlemen, archivist speaking. While the world was distracted by loud political drama and carefully staged international tension, something far quieter took place beneath the surface. No headlines, no alerts, but inside the deepest layers of the global financial system, it triggered immediate concern among those who understand how power really moves. On Friday morning, January 23, 2026, shortly after 10 o'clock Eastern Time, trading floors at the largest financial institutions were operating as normal. Screens flashed, voices overlapped, and liquidity flowed without interruption. Then the phones rang, not ordinary phones, direct lines. On the other end was the Federal Reserve Bank of New York. The question was simple, almost meaningless to anyone outside the system. What is your current dollar-yen price? To the untrained ear, it sounds routine, administrative. But inside central banking culture, this kind of call carries weight. The Federal Reserve already knows the price. They do not call to learn, they call to test. This is what insiders call a rate check. And a rate check is never random, it is a warning. A signal that intervention is being considered. It means liquidity is being measured, not observed. It means someone is preparing to move with size. Why does this matter? Because the global currency market is not truly free. It is stable only as long as it behaves. When it stops behaving, it is corrected. And when correction fails, it is redesigned. Right now, the US dollar has become too strong for the system to tolerate. Its rise has crushed foreign currencies, strained global debt markets, and made American exports uncompetitive. A dollar at these levels does not signal strength. It signals imbalance. History shows us exactly how this ends. To find a real comparison, you must go back 4 decades to 1985. Back then, the dollar was also too powerful. American factories were collapsing, trade deficits were exploding, political pressure was building. Publicly, leaders argued, privately, they coordinated. Finance ministers from the world's largest economies met quietly in New York. What they agreed to became known as the Plaza Accord. It was a deliberate, coordinated effort to weaken the US dollar. The result was dramatic. Over the following 2 years, the dollar lost nearly half its value. US stocks rose sharply in nominal terms, foreign assets inflated. Global imbalances were reset through currency destruction. Now look at the present. A national debt that cannot be serviced, interest costs approaching historic extremes, a collapsing yen threatening Asian bond markets, and a Federal Reserve trapped by its own policy. Rates cannot stay high without bankrupting the government. Rates cannot fall without reigniting inflation. The math has failed. There are only 3 exits from a debt trap this large. Severe austerity, hard default, or silent devaluation. The first is politically impossible. The second is geopolitically catastrophic. That leaves only one option, a controlled currency reset. The phone calls on Friday were not about curiosity. They were not about observation. They were about preparation. This is how it always begins. First come the words, officials change their language. A strong dollar quietly becomes a problem. Trade imbalances dominate speeches. Markets are conditioned before they are moved. Then comes action. When coordination begins, it is never subtle. Liquidity floods the system. Exchange rates gap lower. Long-standing positions unwind violently. What once felt safe becomes dangerous overnight. After the shock comes the slow phase. A managed decline, every rally is capped. Every bounce is sold. The currency weakens step by step, while asset prices rise in nominal terms. Stocks climb. Real estate inflates. But the measuring unit quietly loses meaning. This is how governments survive debt they cannot repay. And it always comes at a cost. Imports become more expensive. Energy prices rise. Purchasing power erodes. Savers lose quietly while debtors are rescued. This is not speculation, it is precedent. The difference now is scale. The numbers are larger. The leverage is higher. The consequences will reach further. Those who believe cash equals safety may soon discover otherwise. Because when systems reach their limit, markets stop being free. They become managed. And when management fails, they are rebuilt, without asking permission from the people who bear the cost. The signal has already been sent. The playbook has already been opened. And history tells us what comes next.